Hey guys, Daniel here and welcome back to the Finance Channel. Today I have 3 stocks that I'm buying in February of 2021. These are all stocks that present a great proposition from both a value and growth standpoint. All of these stocks are growing revenues at an extremely fast pace and are valued pretty fairly amongst people in their space. And we're going to go through that in a second here. But without further ado, let's get into it. So the first stock I have here is the Tattooed Chef, and this is about a $24.50 stock, trading at a market cap of around $1.75 billion. If you don't know what the Tattooed Chef does, they are a plant-based frozen food company. They create a variety of products that fall under the frozen, vegetarian, vegan category. CEO has expressed his desire to expand outside of the frozen food category and into the grocery aisle. And I think this is a company really taking advantage of that growth that we're seeing in veganism and vegetarianism, and I think that's going to continue over the next few years. This company is innovating very quickly. In 2017, they had 2 products. Now they have 38, and next year they're expecting 62. All of these are very healthy, vegetarian, vegan, and can be prepared in around 5 to 10 minutes, which is ideal for their target audience, which is millennials and the younger generation. Since, the younger generation doesn't want to cook for an hour or 2 hours. They want to get their food done quickly, they want it to be healthy, they want it to be vegan and vegetarian. That's kind of what we're going at here with the Tattooed Chef. So the Tattooed Chef has a variety of different partnerships, and some of the main ones are Sam's Club, Walmart, Costco, and Target is one of their more recent ones. Now, a lot of these they have just started to get into this past year here in 2020, and I think 2021 is really going to be the year where they fully expand into almost all the Sam's Club stores, into almost all the Costco stores, into almost all the Target stores. These products are selling very well in each of these giant retailers, and I think they're going to continue to expand. And, they're not just limited to these stores. They've expanded into a variety of other ones in the past 100 days here. Kroger's, 7-Eleven, a variety of different ones, but I really think this company is poised to take advantage of the growth into vegetarianism and veganism, which is why I think that this is the best play in that space. So one of the things that's going to allow the Tattooed Chef to expand their product lineup so quickly and expand into so many different stores in such a quick amount of time is the fact that they're vertically integrated. They take care of the entire process, from when they innovate, come up with an idea of a product. Then they design the product. They have a team that designs the products, makes the packaging, etc. They plant. All of their ingredients come from their farms. They grow. And then we manufacture. They take care of the whole process, and they have a really good idea of how much production capacity they'll need over the next year, and they can prepare for that as well. And being vertically integrated, that's also good for gross margin, as it's obviously much cheaper when you don't have another company trying to profit off of, buying your vegetables from them, or, having other people design your products. If you're vertically integrated, it's obviously much cheaper, and that helps gross margin, which I really like. So this is, we can kind of get an idea of the Tattooed Chef's revenue growth. And this is the really exciting thing, because right now they're trading at around a $1.7 billion valuation. This year they did around $150 million in revenue. In 2021, that's expected to jump to $222 million. In 2022, that's expected to jump to $300 million. In 2023, that's supposed to be $500 million. And by 2026, they're expecting $1 billion in revenue. Now, I think this is very conservative, and these numbers were pretty much the first guidance that the company released, and I think they sandbagged it. I think that they're going to reach $1 billion in revenue by 2025, and given that my price target on the stock is around $60 to $80 per share, which I think they could really hit here over the next few years, and which is why I'm still buying the stock. And honestly, if they execute, this could go very well up to that $100 per share range, which I'm really comfortable with. So this is, again, why I really like the Tattooed Chef. The valuation compared to one of its competitors like Beyond Meat. The Tattooed Chef trades at a market cap of $1.7 billion. Right, this was taken yesterday, so now it's at around $1.75 billion after this run-up we had today. Beyond Meat, trading at a market cap of $10.5 billion. Tattooed Chef is much smaller. And on a forward PE basis, although you can't really look at the forward PE because these are both growth companies growing at 50% plus and will continue to do so over the next coming years here. On a price to sales basis, Tattooed Chef, 12.5 price to sales. Beyond Meat, a price to sales of 26, over double the valuation of the Tattooed Chef. And again, that's one of the things that really cements a low fair value for the Tattooed Chef. Like Beyond Meat's trading at a big premium, obviously because of their well-known brand and a price to sales of 26, meaning that it's a more volatile stock. The Tattooed Chef is trading at a price to sales of 12. So when you see that, you got to really think to yourself, how much cheaper can it get to before it's just at a stupid cheap valuation? It's already cheap at today's prices. So honestly, if it just keeps going down, that's just a great buying opportunity. If you have that mindset of knowing that this is going to be a $80, $100 stock 3, 4, 5 years down the road. So stock number 2 here is Shift. Now Shift trades under ticker symbol SFT at around $8.30 per share. A market cap of $700 million. This is the smallest company that I have in the list here. Now, Shift was a SPAC. They SPAC'd back in 2020, kind of the summer of 2020. They topped out at around $15 per share and have been on a downtrend ever since they completed their merger. Now trading at around $8.30 per share. Now, Shift is a company that is an e-commerce used car sales platform. They sell a variety of different cars, and buyers or sellers can use the platform. Let me make this straight. If you're a seller, you rather go onto Shift's website, you fill out a form, and in 5 to 10 minutes, they give you a quote. And that's essentially the amount of money they're willing to give you for the car. If you accept that, they take care of the whole process. They take the car from your home, they clean it up, they take pictures, they list it on the site. If someone decides to buy the car, then again, Shift takes it to them. You don't have to do anything, which is very convenient from the seller's perspective. If you're a buyer, you go onto their site. And this is one of the things that I like about Shift. They have at-home test drives, meaning that you can essentially test drive a car or ask to test drive a car. A Shift employee will come to your house with the car. You can test drive it and even buy it on the spot right there, which is something that I really like. I really recommend you going over to Shift's website and just kind of taking a look around it. I really think the opportunity here with Shift is big, and I think that they're going to be able to compete with companies like Carvana and Vroom in the future. Carvana is like a $40, $50 billion company. Vroom, several billion dollars of market cap. And in my opinion, Shift is going to benefit from something called price shopping. When you're buying a used car, you don't stay loyal to a certain platform. You price shop. You look across a variety of different sites and look for the best price. So given that, it's not like Apple, where, okay, I like Apple products. I like their brand, so I'm going to continue buying their products. It's not like that with these used car sales platforms, because if Vroom's giving you a better price than Carvana, you're not going to stick with Carvana, because you're getting a same product for a cheaper price, which is why Shift is going to be able to kind of just sneak in there and take market share from Vroom and Carvana. And honestly, the e-commerce used car market only makes up less than 1% of the total car market in the United States. And that's something really exciting. And especially if, let's say, Shift only becomes 10% of what Carvana is. That's a $3 billion company. And at a $700 million valuation, I think they've got a great tailwind going ahead of them for the next few years here. So this is another exciting thing, obviously, with Shift here. Obviously, they're an unprofitable company right now. They lost around $1.74 of EPS in this current year, but next year, that's expected to shrink by around 30-40% to a loss of $1.18. In my opinion, they won't be profitable for a good amount of years. I think 2024 is really the year where they start to hit that break even. And obviously, a large kind of reason for that is the fact that they're growing revenues at over 100% per year. Next year, we're expecting revenues of around $400 million and sales growth of over 100%. Now, is this company going to grow sales by 100% year in and year out? Probably not. But even if that drops by 20% next year, that's still 80% revenue growth. And I think that this is going to be a company growing high double-digit percentage points over the next 3 to 5 years here, as I think that Shift is where Carvana was 4 to 5 years ago. And again, with the valuation, this is what really excites me. Shift trades at a current price to sales of around 4.6 price to sales. And this company is growing at around 100% per year, which means their price to sales for 2021 is 2.3. And that's just going to become cheaper and cheaper as time goes on, which is very unlikely to happen. The stock price has to react to a company that grows by 100% year in and year out. So why is it trading so low? Because of their recent conference call. Shift is a very new company to the stock market, and when they had their conference call, it didn't go the best way. They reported larger than expected spending on marketing and advertisements, which makes sense as Shift is really trying to get their name out. But when analysts were asking the CEO and other management questions, they weren't really giving straight answers and analysts were getting confused. So in my opinion, I think the numbers are going to have to show for themselves the potential of Shift. And over the next 3 to 4 quarters here, I think that's really when Shift is going to get its name out there, because you can't stare away or look away from a company that's growing revenues by 100% per year. It's just incredible. And trading at a $700 million valuation, I really think this is a great proposition. If you want to see like a full analysis on this stock, let me know in the comments section. I might do one over the weekend here. Shift is a company that I own along with the Tattooed Chef. But if you want to see a full analysis, again, let me know in the comments section and drop a like. So not stock number 2, but stock number 3 is Facebook, ticker symbol FB. And Facebook is really self-explanatory in terms of what they do. They're a social media conglomerate. Instagram, Facebook, WhatsApp, and Oculus. Trading at a $757 billion valuation at around $266 per share. Now, I did an analysis on Facebook around November, a few months ago, and at the time it was trading at around $290 per share. And at the time, I said if I was going to buy big tech, I was going to buy Facebook. And that still remains true. But at the time, I think the valuation was a little bit rich. Well, since then, the stock price has dropped and fundamentals have improved. They recently reported incredible numbers in their Q4 results, and the stock actually dropped, which is very surprising, and it's now trading at $266 per share, down from where it was back in August. So over the last 4 or 5 months, Facebook has been flat despite incredible fundamental expansion and growth. So, in my opinion, I like Facebook. I think this is the best kind of safe play to have, the best way to play big tech, and I really like Facebook as a company that just buy and hold. That's why I like it, and that's nothing really more to be said here. They're expecting around 25% growth this year, 20% growth next year. You know, very big growth numbers, especially for a company of its scale, and trading on a valuation of under a 20 forward PE. Is just incredible. I think the stock is undervalued where it is right now. I really like this one as, again, a safe hold, and I think it's the best big tech play out there. So I'm not going to leave Voyager out of here. This is a stock that I've been talking about over the past couple of days here, and it's gone on an absolute run. I recommended this one back in like beginning of January, back at like $5-6 per share. And over the past like week here, it's gone up massively. I mean, this was a $4 stock last week, and now it's up at $11. So would I buy this one? I've already got a position. I've got a decent position, and that position's actually grown into a much bigger percentage of my portfolio. So at this price, I'm not buying. I'm waiting for a bloody red day to really put more money into it. I really want to see like a 10, 20, 30% move downwards before I start buying. I really like this one under $1 billion valuation. But again, if it drops 20%, I'm going to have to buy at least a little. But anyways, guys, thank you so much for watching. I hope you appreciate this content and the videos, or rather the stocks here. I really like these. I own the Tattooed Chef. I own Shift. I know a lot of people that own Facebook. I don't own it. I think I might add it here over the next couple of days, but I really like these stocks over the long term, and I think they present a lot of good value here in the short term. So thank you guys so much for watching, and have a great day.